this type of price action is completely indicative of what you see in bear markets. The whole point of a tail risk hedge, it's so that you have something in your portfolio that ends up making a lot of money when markets become dislocated. Everyone was bearish, but everyone was positioned bullish. I don't think the reflexive bid that is needed to drive equities higher is there anymore. Liquidity has definitely changed. That's something that we noticed on in both directions. Monday, where the S&P went to the absolute low of this recent move, right? We were just throwing out we were throwing these offers out left and right and just saying, if you want it, come get it. Usually when you get those big moves, where vol clusters, it tends to have this memory, and like the market will trade it back there super high. These vol regimes can last way longer than people think. What makes this so different than like previous things is that there are real macroeconomic factors that are at play here.
Kris, thank you so much for coming back on.
Thank you so much for having me.
I was really excited you said yes to this because, I'm kind of a value investor. Obviously we've gone through a really turbulent period in the market, following Liberation Day, and I'm a value investor seeing all this craziness go on in front of me, but I have no idea what's happening behind the scenes. And I know you've got a front row seat to this. So I'm really excited to talk about what you've seen and, what maybe investors can learn from all of it.
Yeah, absolutely. I'm happy to dive in.
But before we do that, I want to talk about what you do in general, because a lot of people may not be familiar with tail risk funds, and some people who are may have misconceptions about them. So there was a great tweet that came out recently, and many people believe these types of funds, they pay out really well, they perform really well during tail risk events, but it's not worth it because they lose money in the other periods. And I think it's fair to say, based on some of the performance stuff about you that's been posted on Twitter recently, that is absolutely not true about what you're doing. So I was hoping maybe you could talk just to start about, in general, how do tail risk funds work?
Yeah, absolutely. So when you think about like the whole point of a tail risk hedge, it's so that you have something in your portfolio that ends up making a lot of money when markets become dislocated, right? And that small piece that you may allocate to something like this ends up covering the losses on the other side of your portfolio, right? So let's say you allocate 5% to this, you're 95% invested in the S&P. If the S&P crashes, this thing could balloon so much in a very convex way that it just offsets the losses, right? And over time, what you realize is that you can compound returns at a higher rate, and the ending return value ends up being higher, right? So it's really appealing for a lot of people, but then there's like a caveat to it, right? Which is like, if done incorrectly, you end up bleeding significant amount of capital over time, right? So what could end up happening is, like, let's say you invest $1 million in something like this, and if the bleed is substantial, maybe you go 3-4 years without a tail event. So then your capital goes all the way down to like 250K. Crash finally happens, and maybe, you just get back to like 750K, which, like, that's kind of tough over a period of time of, 10-15 years of doing this. So like, for years, people have become very intrigued with putting together what we call tail risk solutions. And there's like a really big difference in this. So like, a tail risk solution is like just saying, okay, I'm going to go and I'm going to, on the first of the month, buy a 5 delta VIX call. Because what I realize is that in a back test, this 5 delta VIX call performs really well over the last 3 tail events that have occurred, right? So you say, okay, I'm always going to be buying this, and I'm going to buy it on the first of the month, and I'm going to sell it if it goes up 5 times or 10 times, and like, that's my tail hedge. And then what ends up happening is you run into a month like April, right, where like S&P goes down like 20%, VIX goes up a lot, then the S&P closes flat, and you look at the performance on some of these things and you're like, wow, this did insanely bad, right? And like, this has been the case for years. Like, the institutional market has become very dissatisfied with like long volatility and tail risk programs and hedge funds, because it's the same dilemma over and over, right? Like, you give these managers money, they just lose money nonstop. The tail event happens, they don't make a lot. It's like very weird, right? But like, the biggest thing when we were starting the business, what we tried to point out to people was that, like, there's a way to do this that doesn't just lose money all the time, right? And like, the way to do it is by understanding and actively trading the edge that exists in volatility markets. So like, if you think about like all the really successful prop trading firms in Chicago that are derivatives based, they all have very similar P&L attributions, which it resembles something what we do, which is like during normal markets, maybe you make a couple percent, maybe you're flattish from trading a lot of principal-based flow in and out of stuff, but you're inventorying these tails so that if volatility goes up a lot, you make a lot of money all at once. And I think, when we brought this to the institutional space, like a lot of allocators were sort of scratching their head because they're like, we haven't seen this, and we were scratching our heads because we were like, we've seen this our whole lives. Like this is literally the space that we come from, right? So when you're sitting here and saying this is novel, we're like, I had bosses that trained me how to do this. So I think that's like the big disconnect within that space, right? Is like there's not a core focus on trading this stuff. It's more about packaging a solution and putting it in a very rigid way. And I think that that's where we differ is that and I think that's kind of why the performance has demonstrated that because if you do this in a more trading focused way, there's a way to remain flat in normal markets and make a lot when dislocations occur.
And I think people also underestimate how important, how much these allow you to take advantage of rebalancing. Because the idea is if you have something, if you have an equity portfolio and you have something that's paying out when equities are down big, like the ability to rebalance back into equities is such an advantage for people.
Yeah, absolutely. Like over the course of a full market cycle, like over the course of 5, 10, 20 years, what you realize is being able to do that, it compounds these returns at a higher rate. And the ending return value becomes significantly higher than just saying, okay, I'm just going to hold the S&P and just, wait for forever, right? And I think where some people tend to get things wrong too. And I was thinking about this a lot during this crash because everybody, obviously, retail, looking at some of the numbers, the big story on the street is that retail bought the dip, right? And one of the things that I was thinking about was like, okay, well, sequence risks that exist because I had like, friends reaching out and saying, "Hey, should I buy the dip?" Right? And it's always good on paper to be like, "Yeah, you should buy the dip because over, the next 20 years you're going to make money." But there's a period of time that it takes to actually get back to break even if you're buying the dip in the incorrect spots, right? Imagine buying the S&P at 500, right? Let's just say SPY, for example, you buy SPY at 500 and let's say you go 10 years or 5 years where SPY is going to down to like 300 or then back to 400 and then eventually in 15 years it goes to 700, right? You've just wasted such a long period of time, which is why it's to your point, the rebalancing thing, having something that makes money when markets go down, you take that, you rebalance, you buy discounted assets. That's the whole investing game in my opinion.
This next thing I kind of want to talk to both of you about because you both were sort of saying the same thing coming into this year, which is, Kris, you had, before all of this even happened, you had said you thought this would be a big year for volatility. And in our separate podcast that I do with Brent, he was talking about a lot of the warning signs he was seeing behind the scenes that might lead to the same thing. So I guess, Kris, first, like, what did you see coming into this year that made you think this might be a big year for volatility?
Yeah, so the biggest thing on the institutional side was that we realized a lot of the pensions, a lot of the foundations, I have a bunch of buddies that trade at the multi-strats. Everyone had mentally prepared their Trump 2.0 playbook. And the Trump 2.0 playbook was he's going to be positive for equity markets and equity markets are going to go higher. And to at Amber's, like our view was that okay, positioning is going to be leaned in one direction, like very heavily, right? Because everyone's just like stocks are going to go up, stocks are going to go up. You had foreign investors really interested, like everyone was interested in buying stocks because Trump was going to come in, he's going to be positive for business, and equities would just go haywire, right? To the upside. And whenever that's the case, like it leads to this one-sided positioning, right? It's sort of like a seesaw effect. But then in the interim, what we started realizing, as he got elected and as he started relaying more or signaling towards more policy, we were like, okay, these policy reforms are going to be quite large. And one of the big things that we're very we're very vocal about is that we do not trade on fundamentals. We don't trade on any type of macro thematics. We just trade on flow and positioning. That's like the biggest thing for us, right? So like we had no real view, like, okay, if tariffs are going to net and net be great for the economy, be bad for the economy, it had nothing to do with that. It was just that when you have positioning so one-sided and you have very large policy reform, it's like shaking up a can of soda. Like you're bound to get capital markets don't do a good job digesting that. And that's exactly what we witnessed, right, over the last like few weeks was that capital markets saw all these policies. They were like, all right, we're not sure about this. We're selling equities. Maybe we're going to buy equities, right? And I think we're still in that stage where people are trying to digest something that doesn't definitively have a path right now. So that's why we were like, okay, crazy positioning, crazy policy reform, that usually means volatility is going to go up.
How about you, Brent? You were kind of seeing something similar, right? In options as we came into the year?
Yeah, I mean, I don't have anything to offer that's anywhere near as eloquent as what Kris just offered, but you could see in just a lot of the data that, kind of indexified data that things were just very wonky. You look at correlations and, just different relationships. And also I think just the vol premium. And so I think what I saw is just sort of the manifestation of a lot of things that Kris was talking about. And I think if I'm correct, I don't want to put words in your mouth, Kris, but it seems like you think that we're not quite out of the woods yet here either. I mean, today, as we're talking, the Liberation Day move is now completely unwound. And so Mr. Value Investor Jack has not realized that anything has happened, even though we've had one of the biggest big spikes in some time.
Yeah, I mean, I've been pretty vocal about this that um, I personally don't think that the move is over, right? So like at Amber's trading flow is different than like my personal view, right? So like I'm not just gonna sit there and just press the button and just bet bet everything stocks are going down, right? 'Cause that's a silly thing to do, right? We're very process driven and very focused on how to run a good fund from a trading standpoint, not based on my own views. But personally speaking, based on my own views, yes, I do think that this is going lower for a couple of reasons. But I think the bigger, and I honestly I think this rally higher is affirmation, like more than anything. And I see people on Twitter talking about things like, oh well, like they'll get on people that were saying, hey, stocks are going to go down. They get a lot of like people trolling and stuff on Twitter. They're like, hey, look at this move. I told you markets are going to rally back, right? And like this type of price action is completely indicative of what you see in bear markets, right? It's like literally the opposite. You don't see this in bull markets. Like some of the nastiest rallies come in bear markets.
Mhm.
So from a vol standpoint, like when I'm looking at this from a vol standpoint, I'm looking at this and I'm looking at these flows. I'm like, okay, this is more affirmation than anything. Like if the market would have taken its time and like based and leveled and flow slowly came in and came out, like that would be a different, I'd probably have a different case. I'd be like, maybe we are, bottoming. I don't know. But like when you give me, 9 straight days of just consistent buying and big TWAP orders coming in the order book, and you're looking at things like that, you're like, okay, this probably is indicative that things are going to go lower. But one of the big reasons, again, from a flow standpoint, that I personally think that equities are going to go lower, is that I don't think the reflexive bid that is needed to drive equities higher is there anymore. So like when people are and like for years I was like, oh yeah, stocks are going up. I make jokes and stuff on Twitter, vol's going down, stocks are going up, right? Because when you look over a certain time horizon, they do, right? Like you're kind of silly if you don't think that is the case. But it's not magic, right? What you need to have transpire in equity markets is a persistent bid to get that. So okay, so you have to ask yourself, where does that bid come from? It comes from large domestic pension plans, or it comes from sovereign wealth plans. It comes from rebalancing from foundations, endowments, target date funds in the U.S., domestic RIAs, right? These are huge flows that come in and reflexively drive asset prices higher. So when you look over the last like 2 years and you see stocks just going higher and higher and higher, part of that is because of that process, right? But what ends up happening now is that reflexive bid steps back. So stocks go down, you get a big, a group of big participants that come in and say, okay, here it comes, it's coming back up, right? They buy, 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 buy. And then when that reflexive bid of all those other market participants don't make their way back in, then everyone sort of looks around and they're like, okay, we're at a certain price and nobody else is buying, right? And that's where you lead to this like chop period where the market digests things, and then ultimately makes its way lower. And that's been consistent in the data, not only from like historical moves, but also anecdotally talking with, pensions and talking with endowments and talking with these larger money managers. There has been a reduction of U.S. equity exposure, and that flow is not so focused on getting back the same way how domestic U.S. investors are, right? A lot of retail participants bought this dip, and the reason why is because they are unsure about U.S. policy because the U.S. administration is unsure about U.S. policy, right? So like that's why I think, it's not fundamental, it's not macro based, it's from a flow standpoint. I don't think US equities are going to have that reflexive bid needed to get it back to all-time highs the same way how we've seen over the last few years because of that dynamic.
Do you have enough granularity in your data where you can say when we see a big bounce back like this, like it is probably retail doing this and it's probably not institutions?
So I think you could back out of some of this stuff by looking at ETF flows, all right? Certain products and designators on certain products will help give good color there. Also, just like lot sizes and things like that. But it's an assumption, right? Like you could never be like 100% sure and say, okay, this is coming from here. One of the interesting things that I thought was that, or that indicated that was the case, was that you saw a lot of buying in these upside levered ETFs. Usually, the main demographic of participant in that is the retail community. It's actually not like the larger macro based hedge fund that runs like $15 billion or something like that, right? It's like smaller people that were buying in. I also saw larger inflows into the inverse, VIX products, right? So the short vol products, some of those ETFs like the SVIX, the SVXY, et cetera, et cetera. You noticed that there was a larger inflow that came in there. So that's more indicative to me that retail was shorting vol and retail was also trying to be buying the dip. And then I think Goldman and a couple of other desks put out some data. They may have more granularity on that.
Chris, can I ask, how do you think about just liquidity overall? So, I mean, a lot of Goldman data said this is the worst liquidity that we've seen, particularly in early April, maybe ever, and that was against, massive volumes. But do you think that structurally, even if you look for a little bit before, this April period, that liquidity, just even general metrics, top of book liquidity is fairly robust, or, do you think it's drying up for some of the reasons you mentioned? Does liquidity change because we can just be more quantitative about, how much size we post and, the liquidity is more transient? I mean, what is your sort of general overall take on that?
Yeah, so liquidity has definitely changed. That's something that we noticed in both directions on certain days, and it was kind of surprising to see like the order book just start flatlining in certain places, and the depth of the order book started just like really contracting. And then noticing the type of size in the futures market it took to move markets was like nothing, right? You could have like a smaller based hedge fund actually end up moving markets in certain point in time, and it was just a bit weird. It was almost like everyone in the room just froze and was looking at one another like, okay, I don't know what you're gonna do. I don't know what you're gonna do, but like, I don't know. We're waiting for someone to make a trade. That's honestly what it felt like during down days, like some periods during down days and then some periods during up days. It's pretty weird. So I do think liquidity is drying up. I also think that a part of this is the fact that the market maker community has become so concentrated, right? So like 20 years ago, you may have 30, 40 different desks of market makers that are widely dispersed. And some of them, got taken out. Some of them would be aggressive with taking on risk. Some of them grew. But now it's really just like 6 to 8 desks that really control a bulk of that flow. And on the day where Trump walked back the tariff news and we saw the S&P go up, I don't know, was it like 10% or something? Like that was one of those days where you saw MMs reprice that stuff up like super, super fast. Funny enough, the day that he announced the tariffs, remember stocks went up initially. Like the Liberation Day, like stocks went up. And so I can't say for 100% surety, but the rumor on the street was that was actually an MM who one of their their systems actually just drove price higher,
Hmm.
and then when people didn't follow through, they just puked that stuff out.
Mm.
So it's like you definitely do have these the smaller market maker community shifting around prices a little bit, and then also some of the end user community is able to shift prices around. So it does feel like liquidity is not what it used to be. I mean, I even think back to like 2015, right? Like markets felt a little more fluid, and this is an anecdote. I don't have core data behind this, but markets did feel more fluid in both directions. Now you kind of look at how some of this stuff is trading on big days up and big days down, and you're like, yeah, I don't know. It feels like we could move markets around, right? Like a smaller size hedge fund.
Yeah. The reason I was thinking about this too is because in August of last year, we had the VIX print over 60, right? And I know there's all sorts of that didn't really happen, whatever. The VIX marked over 60, right? And that felt so much like the liquidity just totally disappeared, and that wasn't necessarily tied to an official policy or, like the tariff issue, right? But if you just look back over the last 20, 30 years, we've not had two instances of the VIX moving, like that over 50 in such a short amount of time. I think you have to go back to like kind of 2008. And so far, if you just look at the top of book liquidity on the ES metric, that the CME provides, that the top of book liquidity hasn't come back in. And so we seem to be at a lower level than even the low levels that we had, kind of to your point, coming into this. What do you think would bring that liquidity back or strengthen that liquidity? Does it take signed deals or just time? Like, the volatility has to roll out of the realized window kind of thing?
Yeah, so back like 2 years ago, we wrote that paper on like, is the VIX becoming more leptocurtic, right? Is spot vol beta changing in the U.S. equity market? And like that was to us, like that was our favorite paper, even though it didn't get a lot of love, because I feel like we are literally seeing that whole thing play out now. And all we were saying was that when S&P drops a certain amount, you could see vol explode at higher levels than you have historically, or vice versa, right? When the S&P goes up, you see vol dissipate in lower levels. And a lot of that was based on this, what we call dealer hot potato, with market makers moving stuff up, moving stuff down, right? And changing vol prices. Based on the aggressiveness from the end user community. And the one interesting thing about like VIX pricing is that it all comes off of SPX options, right? So like for people who don't know, the VIX calculation is a strip of SPX options that go off of the bid ask, and it calculates every 15 seconds. So it's a rolling 15-second period that flashes and takes these valuations, and then it prices the index. And what that means is that if people do not make markets on those lines, right? If the bid-ask spread on those lines go wide, the index will price higher, right? That's literally how the calculation works. So like during August, that was one of the big things. You had a bunch of people, or this one, quote unquote, this one like Asian participant who was offside, who was trying to come in the overnight session. They couldn't find liquidity, and because the SPX market is traded overnight, you could buy or sell, these XPX options overnight. The calc was running off of that, and the market makers just removed themselves from the market, right? So the screens just came super wide, and that's where this is where the liquidity problem translates into vol, right? Because screens go super wide, the index calcs super, like, really really high. And yeah, I'm not sure if like getting deals done will bring the liquidity back either. I think this is a microstructural thing. And I think like one thing we're seeing are the NLP programs like really run, right? So these natural language processing programs have run for years on some of these market making desks, right? So some market making desks can act in the respect of actually wearing risk, from a proprietary trading side, right? So sometimes they'll be making markets, and then they also have other things that take directional risk, right? And some of these things run off of just headlines and stuff like that. And that's why, you'll get some headline about like, oh, Trump likes China, and then boom, S&P goes up 1%, right? Like, and we've seen that over like significantly over the last few weeks, right? So I think the market microstructure has changed, and the liquidity is a byproduct of, or the liquidity thinning out is a byproduct of the fact that change is really making its way through.
Art, if I could just follow that thread a little bit. Do you? I'm sure you've heard of Chris Cole, art of like Artemis, and all the famous papers that he wrote. I don't know if you read this one, and Jack, you can strike this from the record. You haven't seen this one, but he wrote this paper called like "What is Water." I don't know if you've ever read that one.
No.
And it's a 10 years old now, 15 years old now, but basically the paper just sort of outlines that we all swim in this liquidity, in this medium that's called liquidity, right? And if you ask a fish, kind of what is water, they wouldn't be able to tell you, because it's just like, it's their ether, is what they exist in, right? And so much of what in trading we rely on is that liquidity. Like, I can get the exit, that liquidity is there, and VIX and in a large way, volatility is just a function of liquidity. And so if the liquidity goes away, then, then there's a whole set of structural problems that, arise from that a lot of people may not kind of account for, which I think is interesting for two reasons. Number one, obviously the volatility we've been talking about, but then it leads to this other thing that I'm curious about. When you get a vol spike like we just had in April, it can be very hard to get filled on orders, right? So your book may be screaming, it's looking good, but those bid-ask vibe out and all that sort of thing. So like, how do you guys think about, monetizing the move? Like, how able are you to monetize moves in that situation, and kind of like, sell into that volatility in the way that, makes your fund so successful?
Okay, so really good questions there. I'll start out by saying that one of the things that we've been working at on the data side, is we have this view that the VIX options have become much more illiquid. So and this is like starting from, I want to say like 7 months ago, me just looking at this 1 month 25 delta VIX call, and I'm like, why are these screens so wide? And I think we have continued to observe more things about just that the percentage between the bid ask spread, right, that NBBO, and that being wider. And I think it's a byproduct of the market making community just being like, we want to make markets when we want, but when we don't want, we're backing away. And like, that's what it is. So I think there's a real dynamic that's occurring right now. In terms of monetization, that's like the biggest thing for a long vol fund, right? Is like, how do you monetize? How do you think about monetizing? And like, that's why some long vol funds have really went out of business, right? Is that you get these big vol spikes and you don't know how to monetize. You don't know how much to monetize. You look at like some of the, we've started to see across from some other allocators of ours, just performance of some other tail risk funds and programs. And it's terrible this month, right? Like, because a lot of people were not able to monetize. So, okay, so how do you think about monetizing? Well, the first thing is, it goes back to understanding historical vol levels and where the prices are today in relation to what is quote unquote fair, right? So if you look at, let's say, a 20, or let's just say a 1 month 10 delta S&P put, maybe historically that may trade at a 30 vol. If you wake up and that's trading at 150 vol and that's never traded that spot before, those are the line items you want to sell back to the market, right? So when we're thinking about selling back, most people think about this as a target return, which is like the worst way you could think about it. You're like, okay, the fund is up 100%. I'm just selling, half of that across the board. That is like that you should not do that at all. And most of these programs operate like that. What ends up happening is you have to have an understanding of what is the vol pricing when you bought these things, and where's the vol pricing now, and where was it at historically? Because if I bought an apple for $1 and there's some guy on the side of the road saying he wants to pay $1,000 for that apple, I'm going to sell it to him, right? Like, there's never in the history of the world been an apple that sold for $1,000 to my knowledge, right? So those are the line items that I want to sell back. So that's how we think about monetizing, is like picking the spots where the market aggressively wants that exposure and selling it back to them at a massive premium. Now it comes into play, okay, well, sometimes screens are super wide. How do you get executed, right? And a part of that is just throwing out what we call stink offers. So like, one of the best times to sell your risk back to the market is when the market first opens up, because it's like basic auction 101 principles, right? Like, everyone comes into the room, they're just like, I don't know where stuff is. Who's the guy that's off sides? What is he willing to bid, right? So that like Monday, when we were coming into markets, I'm forgetting the exact day, but it was a Monday where the S&P went to the absolute low of this recent move, right? We were just throwing out we were throwing these offers out left and right and just saying, if you want it, come get it. Like, here's an orange for $50, come get it, right? Like, here's this VIX call that's like, way, way, way out the money. You want it, come get it at this price. So, and I think that's part of trading, right? Like, that's literally part of trading. Like, if you're trading, these are the things that you need to be, good at. Have good infrastructure to understand what the prices should be. Have good infrastructure to understand where to get executed at. Have good infrastructure to understand how to clear on that execution, and that's kind of what we do. So it's like, you walk into the market and you see who's the guy who's really offsides, why is he overpaying for this stuff, and just quickly try to sell him that risk that you were inventorying. But yes, I will say, and I will speak on behalf of every equity vol trader in the world, like, executing this time around on this like spike was tough because there was some low liquidity there. Like, we would have liked better liquidity. Uh, for the better and the worse, because like on some of these things we got filled at crazy prices, but then there were some other lines that we were like, man, wish the market was a little more liquid because we would like to get that one off.
How much of that is when you're monetizing? How much of that is quantitative, and how much of that is your experience and discretion? Like, is your computer telling you, this is worth this, but I could sell it, this is what the market's trading at, or are you just looking at this yourself and use your experience to decide what to do?
No, so it's a quantitative framework, right? So it's like 70% quantitative and 30% discretionary. So like, one of the big things about being on the discretionary side is like understanding the reason for the dislocation and having some type of a view there. So like on the quantitative side, you could have all these good systems that say this is a screaming sell and you should be giving that back to the market, right? But like on the discretionary side, it's up to us to understand, is someone off sides, right? And this comes with like talking to the voice trading community, right? Like calling up some of the agency guys and saying, hey, do you know why this is trading here? Do you have a guy who's a buyer? Do you have a guy who's a seller, right? Like, that's like part of the discretionary side, understanding the dislocation and the reason why. And I like to say this to my junior trader, that like S&P going down 5% on the Fed hiking rates is very different than S&P going down 5% on a nuclear bomb, right? And you need to be able to decipher the difference between the two. So the quantitative side gives you the prices, it gives you like, historical levels, it highlights to you that this is going on. And then ultimately on the discretionary side, myself and the other co-CIO, William, we're able to look at this and say, okay, we we should be selling that back to the market or not. And this is a really fast process, by the way. Like, this is like within minutes, right, of like making these sort of things go on. And especially that day, we like that whole weekend we got no sleep. Like, everyone was just, because there was so much news coming out here and there. Besson said this, Lutnick said that. Besson went on his one podcast, relayed this whole thing. Trump's tweeting this, right? Like, so you're like, a part of us was like, in the overnight session, we're like, oh man, I hope this doesn't rebound by the morning time. Like, that was like one of the biggest things, was like, we want to delta hedge some of this exposure, and like you obviously do it in the futures market as well, right? But like, we were just like, where are we going to be at when we open? And for us, one of the good things was that we opened, the market started going lower, and we had a chance to like collect ourselves and sell that risk back to the market.
Do you have a feel for, you mentioned at the beginning that everybody was off sides with positioning. People have talked a lot about how the short vol trade is huge. Do you have any feel for if that changed or if that got washed out with this decline at all?
So yeah, I think vol positioning now, it's weird because I feel like it's a little more neutral from what the data is showing, but then what we feel is that it feels like people are more short vol. It feels like the retail community shorted vol. It feels like some of the tactical hedge funds that opportunistically short vol shorted more vol. But then when we kind of look at the data, it's like it kind of feels neutral. So we're kind of mixed there, trying to figure out like, okay, is the street really more short vol positioned, or is it been more of a neutral lean? I will say it's definitely more of a neutral lean compared to like where we were. Last year there were some time periods last year where people were like shorting vol left and right. But ultimately, I'm curious to see that, like, where that shakes out. But I do think that if the S&P goes lower, vol is going to react. That's one thing. Like, I think the positioning being neutral to more slightly short vol, it's too severe of a situation right now to not have vol go higher, especially because you had that massive move. Usually when you get those big moves, where vol clusters, it tends to have this memory, and like the market will trade it back there super high. So like if the S&P were to go down 3% in a day, the market would reprice vol very high.
Yeah, and you think it's going to be pretty sticky this year, right? There was actually an interesting tweet you wrote, which we'll put up, and I can't read them all right now because there's a lot of them, but you had all the examples of situations where vol stayed high for a long period of time. And like someone like me from the outside wouldn't have known there's this many, but you started with 1987 and worked through, and there were just tons of them.
Yeah, that's the thing that gets me so upset when I get on these like pension calls and stuff like that, because you have to talk to this analyst and the analyst will be like, well, there, historically there's only been three vol spikes and vol just goes up and then it goes down, and that's not true, right? Like you've had many situations, if you actually go through the data and look at this, where vol stayed elevated for a very long period of time. Like in 2008, you talk to someone, they're like, oh yeah, VIX went to 80 and then it went right back down. No, it stayed in the 60s for like multiple months, right? It hit 80 on, I think it was like 5 different occasions. And it's funny because you need to look at like an actual like daily chart to showcase this, because some people will pull up VIX, they'll pull up like a monthly or something like that, all these sorts of like weird things. But these vol regimes can last way longer than people think. I think we're just so cognitively biased towards this because the last decade and a half, it really wasn't like that. You had Volmageddon, it went up and it just went straight down. You had 2020, it went up and it went straight down. This past August went up, went straight down. Like you have to sort of read the room in some of the bigger things here. We're at the point where like people are making memes like, okay, nothing ever happens, right? That's a really good antidote. As much as I joke about that stuff too, it's like it's a really good antidote. It tells you where we are. Back in 2017, um, when I was on the desk, like one of the biggest reasons why I knew vol was going to blow out eventually was because I swear I could put my hand on the Bible and say this. There was a cup. I came into the desk one time, and there was a cup that said, "Keep calm and short vol."
Hmm.
And that was so during 2017. That was the thing where it was like keep calm and do this, keep calm and do that. Right? That was like the whole thing. And people were like, now you had it to a point where like certain desks would have keep calm and short vol. I was like, okay, this is like you even had like these like vol conferences like EQD and stuff like that. When people would go to these conferences, they didn't even want to hear long vol. They were like, oh, long vol tail risk hedging? Are you crazy? Give me the guy who's made 30% shorting vol. I need to talk to him, right? Like, so there are these antidotes that exist today, right now in this environment, where I look at this and I'm like, people think vol just goes up and it goes down, goes up and it goes down. But if you look at the data, you'll see that there are very long periods of time where equity vol specifically can stay elevated.
I mean, even 2022, you could argue that it stayed, at least relatively higher than what we've seen in the last 10 years. And, so sticky in the 20s, I guess it was. So,
Yeah.
which is a
What's
mile from where we just were.
And what was interesting to me too is this is not just down markets. Like, I mean, you had 1999 spent much of Q1 in the low 30s. Like a lot of people would not have thought of that being a period where vol was high.
Yeah, for sure. Even it was 97 and 97 or 98 too. We had like a couple of periods where this thing was like in the 40s. Um, I wish I had it in front of me too, because I don't remember each exact data point, but like it is pretty crazy how it's just this cognitive bias that we have. And I think there's like there's a psychological reason for that too, right? Because as humans, we like to evade things that make us feel uncomfortable. That's why like repression exists in the first place, because we're just so innately focused on getting rid of the things that make us feel uncomfortable. So like you look at these data points, you're just like, yeah, that's not what happened. But like if you really look at it and you put yourself through it, you're like, there's a little more, to that story. And also thinking about like the bear market things, right? Right. If we are in a bear market right now, right, we'll look back and we'll be like, oh yeah, remember the S&P rallied like 10% off the lows, like just like every other bear market did, right? Um, so
Is that this other kind of interesting point too? Is that really post 2008? It's been bailout nation, right? So every crisis, every big down move is met with Fed put or something kind of like similar. And in this environment right now, we arguably don't have that put. Like maybe the put is Trump backing off from the policy that led us to the edge of the abyss, so to speak, right? But at what point do we get a rate cut, and does that look like 2022? Because that's all we were waiting for, right? Is like the Fed to stop doing something to us in terms of raising rates and inflation flatten out. But now you're like, when do we actually get something that alleviates the unknown, right? Like when do we get lower rates or whatever it may be? And so maybe all that is like symptomatic, kind of to your point of repression, I guess. It's like my dad has my back or whatever. Like I don't have to worry about it,
Yeah. Yeah. I think the other thing too is just like this stuff takes time. In all the data, it takes time, right? It's just like it's never just one and done and that's it. And I think what makes this so different than like previous things is that there are like real macroeconomic things that are at play here. And I think that if you look at the base case too of just like tariffs, right? You say, okay, 10% tariffs. How in the world is 10% tariffs net and net good for growth stocks or equities in general? I just can't understand. And again, I'm not a macro guy, I'm not a value guy, right? So maybe I'm the wrong guy to be talking about this. But like, even if you get to the base case of what the United States is trying to do, that's still a pretty big impact on growth. That's still a pretty big impact on global trade, right? So like, you have to think that there's going to eventually be some type of impact here. The other big thing or the big data point that we're focused on is just job reductions, right? So like, as the administration has said, okay, we're trying to cut a bunch of jobs, we're cutting the fat on some, and this is like Besant's plan, right? I sat there and I listened to the whole interview with him laying out the plan. It's like, okay, they want to reduce jobs across the board, right? In the government jobs across the board, right? And then what they're going to do is after that, they're going to deregulate the banking side to then stimulate the private sector. And when they deregulate the banking side to stimulate the private sector, that's when all those jobs will get picked up again. So the administration is very vocal about saying, hey, there will be job reductions. This is where this matters for equities because U.S. U.S. household investedness in U.S. equities is the highest it's ever been, right? Okay, so what happens when people lose their jobs? There's less rebalance flows coming from 401k plans. There's less incentive to invest in equities, right? And that whole retail community that just consistently buy the dip, it sort of removes itself. And that's a big impact on stocks. When people lose their jobs in today's market, where everyone in the world is invested in US stocks, it has more of an impact on the reflexive bid in equities. And I think over the course of the next, few months, you'll see, more jobs being pulled away and the impact on some of these people is really sad to say too, right? Because like you hope people don't lose their jobs, but the reality is that if the administration is focused on this, there will be job reductions, and that means that the guy who loses his job, he won't be more inclined to invest in the stock market. He'll be more inclined to save because he's not sure if he'll be able to get another job somewhere else.
Warren Pies had a good tweet about this too, how it works. It's working a lot in the other direction too. So because people own more equities than they have historically, the wealth effect is more now. So when the stock market goes down, the impact on the economy is more because people have more of their money in the stock market that's going down. So it seems like it works in both directions right now.
Absolutely. Yeah, I definitely agree with that.
I wanted to ask you about this AAI thing because I saw you tweeted it and it's been around everywhere recently. This whole thing that, everybody is bearish and the AAI thing is the most bearish it's ever been. And you had a great quote in response to it. And I just wanted to ask you about it. You said the ultimate sentiment indicator is pricing in the derivatives market. So can you explain that?
Oh yeah. Yeah. I mean, the interesting thing about this whole go around was that everyone was bearish, but everyone was positioned bullish. It was really fascinating to watch, especially because we would have calls with like potential investors, and when you get to talk to potential investors, you get to talk about like their current holdings and their outlook on things, and everyone was like, yeah, I think that the world is coming to an end. Trump's doing this, he's doing that, and then it's like, no, we're not selling stocks. We're not. It was the funniest thing. It was the funniest thing ever. You read Twitter, right? Like everyone was like saying the world is coming to an end. Like even obviously, I've had a bearish view, right? But like positionally, all these people couldn't be bearish. Like there's no way. But I think that the vol market is the best sentiment indicator for just like bearishness and sentiment, because one of the things that really stood out was that equity tails never really got going. And I know that's like really surprising for people to believe, but if you look at something like 3 month correlation, didn't really go up a lot, and like that part of the vol surface didn't really come under real stress, right? You didn't have people who were aggressively begging to buy this for protection. You didn't get a ton of margin calls that you would usually see. You didn't get people getting taken out. So it was one of those things where we were looking and we're just like, the market doesn't think that this is going to continue. And even if you completely discount what I just said, the VIX futures market told you exactly that, right? So the VIX futures market naturally prices in this type of mean reversion, right? Which is why like it usually trades at this contango versus backwardation in the term structure. And like the reason why spot VIX was here and the futures were here was because the market was saying we don't think that vol is going to continue, right? So from a pricing standpoint, the market showed you the whole way down that it didn't believe that this would continue. And I mean, I guess ultimately, it ended up being right for now. But usually a good, how to say this, a good sentiment indicator that is a lot of fear and we might be close to a bottom is just a very simple spread of volatility risk premium. And it's just like when implied volatility gets significantly higher than realized volatility, that's usually a good sign people are really scared, right? And people are aggressively bidding for protection. And we didn't see that. As a matter of fact, we saw one of the widest relationships ever, in the complete opposite direction, where 1 month S&P realized vol was in the 30s and the 40s, and then you had VIX trading in the 20s, which is just like, okay, the market really doesn't think this is going on. And I think that that's also a byproduct of the fact of how we've traded for the last few years, right? Which is just buy the dip, short vol, it always comes back, nothing ever happens. We're at that stage where a lot of market participants are like, this isn't going to turn into anything big. It's the same old thing we've seen for years.
Couldn't you make that argument that conditions still exist? I mean, that I think that spread, the risk premium is quite negative still. I mean, we're talking here, VIX is at 22 right now on Friday, and the S&P is up 1.8%. So, it's like there doesn't seem to be, even though we're just ripping the upside, there's still like a lot of volatility, right? So it's like people don't really respect that. And do you think that's kind of required to like drag these people back in, clear out the positioning, that kind of makes for maybe a more painful downside move?
I'm not sure. That's a really good question. I think that eventually, kind of going back to what I was saying with the whole reflexive bid thing, when people buy equities at this rate and then the follow through doesn't come, I think then it will sort of be this effect where people start saying, okay, maybe stocks aren't going to continue to go higher, or maybe they just chop around, right, for a couple of weeks to a couple of months and then they don't go higher, and then that reflexive bid needed to just keep it up and keep it going higher just doesn't show up. I could be totally wrong on that, but if there was ever a market environment where it feels like that reflexive bid won't be there, it feels like this is one of them, because of how aggressive Trump has been with relaying the policy stuff and with how tactical investing and passive investing has changed throughout the years.
You mentioning the volatility risk premium actually gets at what I wanted to ask you next, because this is something you tweeted that I thought was really interesting. And it was from Midwestern Hedgie, who said every major bear market since the dot-com bust has been hugely telegraphed in advance. Things were falling apart, but indices held up until the tidal wave actually hit the shore. And you retweeted that and said, this has been true even with data prior to the dot-com bubble. Today, it's even more relevant given how reflexive passive flows can help sustain higher equity prices. So I'm wondering if you could just talk about that a little bit.
Yeah, totally. So if you go back, I don't have all the data points in front of me. I don't remember them off the top of my head, but if you go back to like just certain thematics in like the 40s and the 50s and 70s and all that, and what you'll see is that like equity markets don't really react immediately as people think and digest the whole thing when people like at that. And I think back to COVID, because that was an environment that I did extremely well trading in, and my view on COVID was wrong. Like, honestly, I was one of those people at the beginning of COVID where I was like, maybe this is over in like 3-4 months. But like my trading was different. I had the best trading period of my entire career was during that. And it was because like I was able to buy such super cheap vol the whole way through, and especially as things were cracking, vol remained somewhat cheap. Um, and I think that like, because think people knew about COVID in December. There were news about COVID coming out in January, and there was warnings about COVID in February, right? It wasn't until that like late February period that S&P started to crack, and then obviously in the early parts of March is when the market really digested it. So I think naturally speaking, you do have people that try to fade this because of how they've been rewarded over the last, few years. But then also the passive flows do play a part in this as well, right? Like the rebalance flows that come in, hedging flows that come in, all those sort of things create this reflexive impact. But I also think that the reflexive impact won't be as extreme and stretched to get equity valuations at those extreme levels that we've seen in the past. Like it'll be really challenging to see the equity market go to all-time highs, right? And people ask me like say, okay, well, Kris, you say that you trade through this stuff, right? Like, and you don't really have these sort of like biased views, right? Because you're a trader and you trade through this stuff. So, but where do you view this as you being wrong? And my like reaction on that is the market's gonna have to really show me I'm wrong here. Like I'm gonna need to see like all-time highs before I really feel like, okay, my view on market microstructure was completely wrong, and like, yeah, I guess we are going into a bull market. And okay, and the reason why I have that view is because bear markets operate just like this. Like this is literally how they operate. You have big pulls down, big reflexive burst back. People come in, you have passive flows coming in, which are more emphasized today than they were 20 years ago or 10 years ago. So it's expected that you get two-way volatility. I have this thing that I always say. I say like upside vol is still vol, but it's so true. It's like two-way volatility is more affirmation than anything. Even though VIX might be going down, like realized vol tells me that we're not in an environment that people are going to be putting exposure to on high leverage and consistently rebalancing.
Do you have any tips? You were talking about how you were wrong personally about COVID, but you did really well on the trading side. Like that's something that I think applies to investors, applies to traders, applies to everyone because everyone lets their emotions get in the way. They have their personal opinions, they have their political views. And I'm just wondering if you have any tips for people in terms of how you're able to separate that, like what you feel personally with what you're seeing in front of you and how you're trading.
I think being intellectually honest with yourself is like really important. And I think a lot of people in the trading community who are good traders, they have that same sort of view where they're like okay with understanding the realities to things. I think sometimes it might take some work, it might take some psychological work. But the good thing about markets is that they tell you if you're right or wrong, right? Because like the ending is the P&L. So like there is no gray. It's like you've made money or you lost money, right? But yeah, I mean, like every hedge fund manager, like his job is to is to obviously manage risk and obviously trade through stuff, but you're gonna have these sort of political views, you're gonna have these internal views on things, and you have to realize that what you do is just process driven, and really stick to the process, and if you really believe in the process. So, uh, I like sometimes I read these like old trader adages and things like that. I'm big into like the old school trading books, like the old Market Wizards book, Biggest Loser by Tom Huggard and stuff like that. Way of the Turtle, like some of the old corny ones that a lot of people would just like cringe at. Like I love it because I think the trading psyche is a really big deal. Because it helps you realign yourself and give yourself the positive affirmations needed to not get too attached to a view that could ultimately harm yourself or your investors.
You mentioned passive flows earlier, and I just wanted to ask you about that because that's something we've had Mike Green on like 4 or 5 times now. And we've talked about his thesis, which I'm sure you're probably familiar with, about passive flows and this idea that it's just this constant bid, driving the market up, but that if passive flows, with everybody putting money in their 401ks, if that ever reversed, that could be a really, significant negative event for markets. And you come at this like in a completely different place than I do, seeing stuff behind the scenes. So I was just wondering if you had thoughts on that, like that idea in general.
I totally agree with it. I think Mike's take on it is spot on. We sort of are in the same band camp. I know this view seemed like very novel 5 or 6 years ago, but I think now it's really hard to deny that data. I mean, you're seeing it on a day by day, right? You're seeing, think about like how many bank desks put out research on like end of month rebalancing and like CTA flows and stuff 10 years ago. Not that many, right? Like now this has become a thing, right? Like Brent, to your thing, right? Like how many banks were talking about dealers hedging gamma like 10 years ago, right? Like now it's like, everyone tries to put out, stuff on that from the banking side. And so like these flows are very relevant. And the passive investing thing is very relevant. And I think it works in both directions too. We just haven't seen the other side of it yet.
I was just thinking about the COVID crash, which is this is a bit out of sequence, but to your point, it took a long time for the market to sort of react. I don't know, and this, whatever your if you ever had a thought onto why all of a sudden the market just came to such a quick reckoning at the end of February, and if there's any kind of like parallel to now, where it's sort of like this is the moment where suddenly the market wants to price in like all of this downside risk. Like, is there like a signal that the average investor can look at? It's like, well, this is the signal that this is all about to kind of start to break down.
I'm not too sure if I could give like a direct signal like that, but I think um historically one of the signals that is just so vanilla but seems to have just good efficacy behind it is just the contango to backwardation signal. It's just like if the
In
front
VIX
month,
or SMD or
yeah, in VIX. So just um like you could take a weighting of the two front month futures, and we call it VXW, which is VIX weighted, and then just price that to actual spot VIX, and whenever that's in backwardation, that's just like a hazard sign that okay, no good things happen here. Some people look at it the opposite way, where they're just like, oh yeah, we like to short vol when it's high. Um, for us, it sort of feels like that's like the areas that tell you like you should not be shorting vol, which is why like I said this on Twitter a lot too. Like when VIX was in the 30s, and obviously it's come down from that point, right? But I was saying like I would not be shorting vol here. I'd be long vol here. And people are like, why would you be long vol here? Because like the term structure is rolling higher. You're literally getting free convexity. You're getting paid to take on that convexity, right? Which is just something that's like very abnormal. Um, that didn't seem to work out because obviously the equities went higher. But like when generally in those environments where like the you know spot VIX is higher than the two front month, and you're able to buy that at a really low period where realized vol is higher, it's a really good bet.
Mhm.
Um, it's like someone giving you, 7 or 100 to 1 odds on something that is a 60% hit rate. You're gonna take the bet. It may land on 40% hit rate, right? Like,
Yeah.
and you lose, but like, still a good bet, and that's how you get paid as a trader. Eventually, over time, taking the win.
Does the level of VIX tell us anything at all about the future, like whether you should be long or short volatility? Like, are there any rules at all of saying like when it's low you should be long, or when it's high you should be short, or is that basically meaningless in terms of the way people should look at it?
It really depends, like which quant you're asking. VIX is one of those things that's like bimodal, right? It's like mean reverting, but it also clusters, right? And it's like a mental paradox. Like, how could it be both of those things, right? But I think you have to break down vol moves per environment. So like the way how the term structure reacts when VIX is in the 13s is very different than the way the term structure reacts when VIX is in the 30s. And then you also have like a sample size dilemma because like when you're in the 30s, in the 40s and the 50s, you don't have, hundreds and thousands of different data points than you had in the teens. So it's a tricky thing. I would say it's just the absolute level of VIX is good for telling you, um, where the market's fear really lies. And personally speaking, some people be like, oh, you got a bunch of nerds that will argue the semantics around, is it the fear index? Is it this? Is it that? Like, look, if VIX is at 50, people are clearly scared, right? Like,
Mhm.
you know what I'm saying? Like for that time period, they are clearly scared. I think you could just look at it in a generalized way of thinking about it in that frame.
Kris, thank you so much for joining us. This was awesome. It was really great to be able to see what's going on behind the scenes for someone like me who doesn't. So we really appreciate your time. If people want to find out more about you, where can they go?
Yeah, they could go to ampersgroup.com or my Twitter, KSIDIII. Yeah, please be aware of the fake Twitter accounts and stuff. Apparently, people are like falling for that, which is like really weird. I only have one Twitter account, just go to ambersgroup.com if you'd like to chat. We're always happy to chat, especially about volatility trading, long volatility, and tail risk hedging.
And Brent, thank you for doing this. Thank you for hopefully making me not look too dumb on these topics. I appreciate you jumping in and helping.
Yeah, absolutely. It's always fun to talk to Kris and learn a lot. So thanks.
Yeah, you guys.
Thanks everybody for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.